Hi guys, so welcome to our next video. So in this recording, I am recording question 4 from a 2020 exam paper. And this question covers Learning Unit 4, Financial Statements of the Sole Trader. And in this question, you have to do 1, 2, 3, 4. You've got to record 4 journal entries in the general journal. So I highly recommend that you go through that question, because that's one of the notoriously badly done questions by students. They, for some reason, battle with the general journal. So 4.1, we've got to do 4 journal entries in our general journal, and then from a pre-adjustment trial balance and a list of adjustments, the students then have to prepare the final statement of profit or loss and other comprehensive income for the year after adjustments, and then also the statement of changes in equity for the year after they've then completed their statement of profit or loss. So it's a really nice question. So let's just go and have a look at it now. So let me just pull that up for you. All right, so it's a 40-mark question. So remember, that means that you must be able to complete this question in 40 minutes, no more than that. And if it's going to take you more than that, then you just move on to the next question and come back to it later, leave space and come back to it later. So always just read the little beginning blurb of the question. Here we've got young traders. They're owned by Von Young. They are not a VAT vendor, so that just tells you, if you've got to do any journal entries, that you do not have to take that into account. Highlight, guys, you've got to take a highlighter with you to the exams. A red pen, what do you call those things? Koki pens or colored gel pens, so that you can use these colors and highlights and circles and underlines for all the important information. It makes a massive difference. The business uses the perpetual inventory system, so that is also very important to highlight, because then we know that this company will have a cost of sales account in their trial balance, and also that every time there is movement on their trading inventory, that they do record that movement in the general ledger. Goods are sold at a markup of 50% on cost. So that's super important. We need to highlight that. And I'll show you the little calculation now, our little cheats way. Remember, I've showed you that you will write down on your question paper right at the beginning, and that you will then refer to if you've got to do any calculations regarding markups. So you'll use this calculation if you have to, if they give you a cost and you've got to calculate a selling price, or if they give you a selling price and you have to work out the cost of sales of that amount. Then the following pre-adjustment, so that's important that this is a pre-adjustment trial balance, appeared in the books at the end of their current financial year, which is the 30th of April 2020. So we've got to the end of the year, we've posted all of our subsidiary journals, and we're in that process of doing all of our year-end adjustments. We're processing our depreciation, we're doing our cash book recon, our debtors and creditors recons. We then go and check through our books to see if we've got any expense accruals or income accruals that we've got to do, and also look to see if we've got any prepayments. Has anybody prepaid us, or have we prepaid any expenses as well? Those are the usual adjustments that we make. And we also, the other ones that we always do at the year end, we go and do a physical stock count, and we compare the physical stock count to our book value of inventory and make adjustments if necessary. We also consider whether we want to adjust our carrying balances for our allowance for credit losses and our allowance for settlement discount if we've got one. And we also go through our debtors ledger, and we assess to see if there are any of those debtors accounts that we need to write off to bad debts, because we doubt that we are ever going to receive that money. So this is what happens in a business at the end of every financial year. It's a usual process. And in big businesses, you do this process at the end of every month to make sure that you are always up to date with these entries, and your accounts are always reflecting correctly according to what's actually happening in your business. So just to go back to this markup on cost price. So let me see if I've got somewhere where I've got space. So when we know that our basic calculation is cost plus the profit or markup. Remember, profit and markup, same thing, equals our sales or our selling price. When they tell us that the markup is on cost price, so whichever amount that the markup is on, so in other words, have they told you the markup is on cost, or have they told you the markup is on the selling price? Whichever one it is, you go to, so here in this case, it's the markup on cost price. We go to cost price and we write 100 underneath cost, because the markup is on cost. So cost is then our base amount of 100%. If the question says the markup is 50% on selling price, you would then go to the sales side and you would write 100 underneath sales, because if the markup is on sales, then sales is your base starting point of 100%. Okay, in this case, it's 50% on cost. So we write 100 under cost. They've told us that the markup is 50%. So we put 50 under the markup column, which is for profit. And then in this case, 100 plus 50 equals sales. So that means that our selling price is 150 parts. Our cost is 100 parts and our profit is 50 parts. And that then gives you your proportions for any calculations that you've then got to do, depending on did they give us the cost figure and we have to work out sales, or did they give us the sales figure and we've got to work out cost, or do we have to work out what the amount of profit is on a particular transaction? Okay, but you're always going to write what I've got here on this answer book here. You are always going to write that down the moment that you've got that information. And then when you're doing your transactions, you'll come back and you'll use this as your little calculator. And then you will never make a mistake when you've got to work out cost of sales, markups, or anything like that. You'll use this exact same method for VAT, because remember, VAT is basically a markup on your base selling price. So for VAT, you would have, excluding VAT would be 100. Instead of profit, that would say VAT, that would always be 15. And then instead of sales, that would say including VAT, and that would be 115. Sorry, did I say including first? It would be excluding VAT is always 100. VAT will always be 15, and including VAT will always be 115. And then that also gives you your base calculator that you will then come back to use to calculate whichever missing amount your question requires you to do. All right, so here's our trial balance. They've given us capital, and take note that this capital amount is as at the first day of the year. So in other words, that's our capital before we have added any contributions, taken off any drawings for the year, or added any profit for the year. That's our opening capital for the year. We've got vehicles and accumulated depreciation vehicles. We've got a fixed deposit that we earn interest at 12% per annum on. Trading inventory, debtors control. We've got an allowance for credit losses. So remember, the allowance for credit losses belongs with debtors control, just like the accumulated depreciation belongs with its asset account. We've got creditors control. We've got money in our bank because it's on the debit side. So that means it's a positive bank balance. So all of those accounts from capital up to bank are our balance sheet accounts. Okay, statement of financial position. Statement of financial position. So if in a question they ask you for statement of financial position, these are the accounts we would use here, and we would then arrange them nice and neatly into assets at the top and owner's equity and liabilities underneath that. And our assets would be split between non-current and current assets, and our liabilities would be split between non-current and current liabilities. So that is what those accounts are all for. Then the rest of these accounts, sales, cost of sales, sales returns, salaries and wages, stationery, carriage on sales, credit losses on telephone, these are all of our income and expenses. So these are the accounts that we will use for our statement of comprehensive income. You'll often see that written as SOCI, Statement of Comprehensive Income. I also like to just call it the Statement of Profit or Loss, SPL. Okay. And these are all of my income and expenses. These ones at the top are all of my assets and liabilities. And then obviously also my capital account, owner's equity. Okay. You must know that backwards. You must, if they muddle all of these accounts up, if they give you a trial balance where it's not, where they are not sorted like this, you should be able to identify, go through each account and name it: asset, liability, non-current, current, owner's equity, income, expense. You should be able to do that, and you should actually practice doing that. That's really very good practice, because that is at the absolute core of being able to do your accounting. Because if you don't know what element the account belongs under in your financial statements, you won't know whether to debit or credit that account when it increases or decreases. So that's something that you must absolutely practice. Okay, so that's what they've given us. Our trial balance is in balance. And then let's go and have a look at what they've got. Additional information and adjustments at year end. There we're going to have some various adjustments. So these are obviously all of our year end adjustments and corrections that we're going to make. And let's just have a look at what the required is. So they said journalize adjustments 2, 3, 7, and 8 only. Guys, please read this carefully. If they've only asked for those 4, then only do those 4. I can't tell you how many times I'll mark a paper and the students haven't paid attention to this, and then they've got 8 journal entries where they only had to do 4. And what are you doing? You are wasting your minutes. So make sure you only do what is asked for, but that also at the same time you do everything that they ask you for. Narrations are not required, so that will also save you some time. And remember to show all of your work in so NB, NB, NB. I can't tell you how hard it is to mark a paper if a student does not show their workings on their answer book. So what do they mean by journalize? They say journalize adjustments 2, 3, 7, and 8 only. So that means we, our subsidiary journal, remember one of our 8 subsidiary journals, the general journal, not the general ledger, the general journal, they want us to record those 4 transactions in the general journal. So again, this goes back to, you must be able to identify what element the account is that you are adjusting in these 4 transactions, and also whether, so in other words, is it an asset or an expense or whatever, so that you know whether to debit or credit the account, so you get your general journal, you get your journal entry the right way around. Then 4.2 says prepare the statement of profit or loss and other comprehensive income. This one here, please read it carefully, highlight it, stare at it and make sure that you understand. Have they asked you for the statement of profit or loss? In other words, my income accounts minus my expenses accounts, calculating my profits. Or have they asked you for the statement of financial position, which is the assets and liabilities? I know it's very difficult and you can panic in an exam, but honestly, guys, sometimes I get students writing the whole question and giving the incorrect statement. And I'm sure they know what the correct one is, but they panic and they misread, and then they will then lose all of those marks. Remember to show all of your work-ins. And most important, you must show in your work-ins whether you have added or subtracted that adjustment amount that you are in your work-ins. Okay. And then for 5 marks, prepare the statement of changes in equity. So that we can only do once we know what the profit for the year is, and everything else we need will be in the trial balance that we've already got. Okay. So let's go and have a look at this. Journalize in the general journal 2, 3, 7, and 8. So we're going to highlight 2, 3, 7, and 8. And we're going to make sure that we do 2, 3, 7, and 8, 2, 3, 7, and 8. Yes, we highlighted the correct ones. And now we can go and have a look to see what we need to do. So remember, your general journal is where you've got your document date details and then 1 debit column and 1 credit column. That's what the general journal's columns are made up of. 2, an amount of 2,500 was prepaid on carriage on sales on goods that will only be delivered in March. So we've sold some goods, or we're in the process of selling goods to a customer. We are obviously going to be paying the delivery charges, and in agreement with the carrier, we've already paid them 2,500 now in, what was the date? 30th of April. Okay, this date's full, so this is not, this is 30th of April 2020. So this can't be March 2020. If this must be April, this must be May 2020. Okay, the goods will be delivered next month. And we've already paid the carriage, but the sale and the expense is actually only going to be incurred in May. So that means that this 2,500 cost or expense is already sitting in my books, in my trial balance, because I've paid it already, which means when I paid it, I debited the expense account carriage on sales and I credited my bank account. So if you go up here, expense account carriage on sales 23,700, that means included in that 23,700 is an amount of 2,500 that shouldn't be there in this current year's expenses. It only belongs to next year's expenses. So that's what prepayments means. So we want to go and correct that. So we want to reduce this expense in this year and transfer that expense so that we'll only take it into account next year. So under journal voucher name, we've written number 2 because that's our transaction number 2. We know that carriage on sales, which is an expense account, we want to reduce the amount sitting in that account. So we are going to credit carriage on sales. Okay, because remember again, always write this down on your paper, your dead click. When an expense increases, it increases on the debit side, which means when it decreases, it will decrease on the opposite side, or decrease on the credit side. So this column is my debits, this column is my credits. Write it at the top there if it's not there, so that you don't get muddled up. And you will write dead click down next to on your answer book somewhere so that you can keep referring to it when you need to. Okay, so now we know that we must reduce carriage on expenses by 2.5. But remember, we use the double entry system, which means if I've credited something with 2.5, I have to debit something else with 2.5. So you can straight away just go and write that 2.5 on the debit side, because you know that something must be debited with 2.5. Even if you can't remember the name of the account, you'll still get that mark for writing the amount down. But they've told you in the question that you've prepaid that 2.5, so then you just write down here prepayment. So even if you just wrote down the word prepayments, you'll get that mark. But the correct one is then prepaid expenses. So this is a debit. So this carriage on sales is already an expense. And we are reducing our expenses for the current year. So what are the other elements that increase on the debit side? Expenses, assets, and drawings. So if this is not an expense, then it has to be an asset. Prepaid expenses is an asset, and remember in your notes for financial statements, you would then include that under your note that is headed trade and other receivables. They said they don't require a narration, but if they did require a narration, you would write that little description here on the line underneath your account that I'm going to debit, underneath that the account that I'm going to credit, and then underneath that you would then put the narration. And if they did ask you for that carriage, you would just write something like carriage was prepaid on a May delivery. And then in a general journal, and this is, you do it in real life, and you should do it when you are recording these as well. When you've completed that, you draw a line indicating that that is the end of that journal entry. Each journal entry is completely separate from the next journal entry. So then we'll go to transaction number 3. Whoops, oh, wrong way. To see what we've got to do for this one. So in this one, a debtor, Joe Jones, is insolvent. So that means he's gone bankrupt or got no money left. And his debt of 3,500, so that means he owes us 3,500, must be written off as irrecoverable. So that means that that is now a bad debt, or in other words, a credit loss. And at the end of every financial year, we always do that. We go through our debtors books and we examine every single customer's account, and we assess to see whether there is anything that we need to write off to bad debts or not. Okay, so that's it. We've got to write off 3,500 to bad debts. So where is this 3,500 Rand currently sitting in our accounts? He owes us this money, which means that that 3,500 is currently included in our debtors control account and in our debtors ledger in Joe Jones's personal account. So we've got to reduce debtors control by 3,500 because Joe Jones is not going to pay us that money. And we've got to write it off. So again, you already know that debtors control is where that amount is sitting, and that we know that debtors control is an asset account, and we want to reduce the assets. So when we reduce assets, because asset increases on the debit side, assets will decrease on the credit side. So you put the 3,500 on the credit side next to the line item that says debtors control or trade debtors, and then in brackets you can write Joe Jones to indicate that we've got to debit the debtors, credit the debtors control account, but we've also got to go to Joe Jones's account in the debtors ledger and credit the 3,500 on his personal account as well. Okay, we don't have to do it in this question, but in practice we would have to do that in both places. So again, we know we have credited debtors control with 3,500, which means we know we have to debit something else with 3,500. So you straight away just go and write 3,500 on the debit column. And then you decide what that account is going to be called. And they've told us here must be written off as irrecoverable. So here you could call this account bad debts, you could call it credit losses, or you could call it irrecoverable debts. Any of that would be acceptable. Remember, what goes into this details column in our general journal this column must contain the names of the general ledger accounts that are being debited and credited. Not a description or a story, but the name, the actual official name of the account, and only the name of the account. Okay, so now we're going to debit credit losses, which is an expense account. So, and I can't drag this around. I'm sorry, guys. Can't make this work. Let me write it underneath there. Expense, and I don't, yeah, sorry, I can't. Okay, credit losses is an expense account, and debtors control is an asset account. So we have increased our expenses by 3,500, which we understand that makes sense because I had to write off a debt. That means that the business has incurred an expense of a bad debt. Okay, and then again, if they had asked you for a narration, we would write over here something like write off insolvent debtors account. And then we would then again rule a line at the bottom of that journal entry. Okay, so this journal entry here, number 2, stands entirely on its own, and this one here, number 3, stands entirely on its own. So each of these individual journal entries, the debits must equal the credits. 2.5 debit, 2.5 credit, 3.5 debit, 3.5 credit. And then we go and have a look to see what's our next journal entry that we've got to do. So transaction number 7, an amount of 1,000 Rand. We don't want to get our amount incorrect. That was for a telephone account was incorrectly debited to salaries and wages. So when we paid our telephone account, we sent the check off. Hopefully we sent the check off to the correct place, but we debited salaries and wages and credited bank instead of debiting telephone and crediting bank. So in this original journal entry that we did, only the one side of it is incorrect. Remember, we debited salaries and wages and credited bank. The fact that we credited bank is correct. It's only the debit to salaries and wages that's incorrect, and we must correct that part of the journal. So we've got to reverse the debit to salaries and wages and debit the telephone account, which was the account that should have been debited in the first place. So we want to debit telephone, which is an expense account. So telephone expense is increasing by 1,000 Rand. And we are going to credit salaries and wages, which is also an expense account, by 1,000 Rand. So we are reversing the incorrect debit to salaries and wages by crediting that account. So, but the credit will cancel out the debit that we already put there. It will cancel it out to 0, so that there's a net effect of 0 to salaries and wages. And we will then debit telephone. So again, we can see I've debited 1,000 and I've credited 1,000. So my journal entry balances. And if they had asked you for a narration underneath here, we would have written here correction of error when paying the telephone account. Anything to that effect. And we finished our journal entry, number 7, and we rule a line underneath it. I'm showing you this fact that you rule a line underneath it to get you used to it, because honestly, if you get used to doing your journal entries like that, you'll very quickly see that each one of these is a separate transaction, and just because it is the general journal, we record each transaction one underneath each other using these same columns. You would usually have a date column, date, folio, details, debit, credit. Okay, so in the general journal, those are the only column headings that we need, because in each of our journal entries, we will be debiting an account and crediting an account, making sure that the debits and credits equal each other. And remember, we use the general journal for our sundry entries. So in other words, for all of those entries from transactions that do not belong in one of our cash books, CBR, CBP, or petty cash, and that do not belong in one of our credit journals, DJ, DAJ, CJ, or CAJ. So if they don't belong in one of those journals, then we record it in the general journal, sundry transactions. And then the last one, number 8, young traders invested the fixed deposit with ABBA Bank. So we'll go and check that out on the 1st of May 2019. So that's when the money was put into the bank. And the fixed deposit will mature on the 30th of April 21. So we've still got another year to sit in there. And the interest for the current year, in other words, the year 2020, must still be provided. So in other words, we haven't yet recorded the interest income that we have earned on this fixed deposit account. So we must go and record that interest that we have earned. So we go and have a look at our trial balance. We are looking for our fixed deposit. So here it is here. We just ignore that. Oh, that's not going to work. Okay, anyway, just ignore that. So we've invested 75,000 Rand into our fixed deposit account, and it is earning 12% per annum. We invested it on the 1st of, what did they say, 1st of May 2019, and 1 year later that is still invested. So we have to record 12 months worth of interest. Always double check your dates. 1st of May 2019, which would have been the first day of this financial year, because this financial year would have started on the 1st of May 2019 and it would end on the 30th of April. And then our new financial year will start on the 1st of May 2020 and run through till the 30th of April 2021. Okay. So 75,000 at 12%, and we must go and record that interest earned. So first do your calculation and show the calculation. 12% of 75,000 is 9,000 Rand. So that's the amount of interest that we've earned this year. Interest is an income. Oopsie daisy, what have I got there? Is an income. And over here, income increases on the credit side. It's one of our click accounts. Income increases on the credit side. So the 9,000 must go to the, you could also have called this interest income or interest received, and then to show that it's an income account, and then put the 9,000 on the credit side. Then we know that there must also be a 9,000 Rand debit, so that our journal entry will balance debit of 9 and a credit of 9. And because this is income that we are accruing, because the bank hasn't given us our bank statement yet, so we are recording the income in the meantime, because we know that it's been earned for this financial year, so it must be recorded in this financial year. So we are accruing the income to the financial year to which it belongs. So we are debiting the accrued income account. So again, if you look at our debit accounts, if an account increases on the debit side, it is either an expense account, an asset account, or drawings. So it's definitely not an expense account because we've just recorded 9,000 Rand income. So that means that this must be an asset account. So this accrued income would also be included in our trade and other receivables note to our financial statement, the same as our prepaid expenses. Those two are both debits, they are both assets. And in the note for trade debtors and other receivables, that's where those two amounts would belong. Narration, recording of interest for the year, and then rule off, and we've done all 4 of our journal entries that we needed to do for that first part of the question. Okay, so remember your format, remember your process. Debits must equal the credits, rule off after each separate journal entry. What goes in the details is only the name of the general ledger account being debited and the name of the general ledger account being credited. In the general journal, as a matter of form, we always write the debit account first and the account that we are crediting goes underneath. That is convention. It's just always done like that. If you are wondering, you can, if you go and you look in your textbook, you'll see all the examples. The debit is on top and the credit is underneath. That's just a matter of form, of convention, that we always do that. It's I don't really want to use the word tradition. It's just the correct format for accounting. Okay, so that should have taken you no longer than 13 minutes to do that. The next thing that we've got to do for 22 marks in 22 minutes is prepare the statement of profit or loss. Remember to show all our workings and all our adjustment amounts as well. So again, we know what we're starting off with, but these are the accounts that we've already got. We have, as a result of some of these corrections or year-end adjustments, we will be creating some new accounts that aren't currently listed here, which is usually depreciation, accrued expenses, accrued income, what else? Adjustment for credit losses. Those are usually the type of adjustments that we've got to make, which would involve additional accounts being inserted here. Okay. So first, always go and have a look at what your transactions are before you write down your statement of profit or loss, because when you write down your statement of profit or loss, all of your accounts, income accounts must go first, and then your expense accounts must come underneath that, and they must be in the correct order. So you must make sure that you know what all of the accounts are that you're going to use before you write it all down. So let's have a look what else we've got here. What else is going to be adjusted? According to a physical stock taking, stationery on hand amounted to 4,500. So that's stationery amounted to 4,500. So what are we going to do with that? I've got a stationery expense account, and of that 84,500, 4,500 of that I did not use in this year, so I must reduce my expense for stationery by 4,500. Okay, so what would our journal entry be? We are going to credit stationery 4,500, and we are going to debit prepaid expenses. Sorry, not prepaid expenses, this is stationery. We would debit consumables. Stationery is considered a consumable. So we would debit consumables. In other words, it's an inventory account. And credit stationery. So we've made one adjustment already to our carrying value that will appear in our final trial balance. So also what I like to tell the students to do as you go through these, make sure that you tick them off, that you know that you have done what you're supposed to do with those amounts. Then also trading inventory on hand is 147,000. So we go up here to trading inventory. We've got 149, and it is actually only 147,000. So we must adjust it to equal 147,000, which means we've got to do a journal entry for 2,000 to reduce our asset inventory by 2,000. So we'll credit our inventory account by 2,000 to reduce it, and we will debit our cost of sales account. So our cost of sales account is going to increase by 2,000. And that's just because cost of sales, whenever we make an inventory an adjustment, or we lose inventory or have to write it off for some reason, we always debit cost of sales with that expense. Because remember, cost of sales is the account that holds the cost of all of the inventory that I sold in order to make these sales. So that's both the stationery and the inventory. Then this amount of 2.5 was prepaid on carriage on sales. So 2.5 carriage on sales, this account, it was a prepayment, which means that I must reduce that by 2.5, which will give me a new balance of, what will that be, 21.2. We've already done that journal entry in our general journal. But that's what the adjustment is that will be done on this account. So we've accounted for that. And then we've got a debtor is insolvent. His debt of 3.5 must be written off as irrecoverable. We've already done that journal entry. And over here, which is credit losses of 3.5. So this credit losses is increasing by 3.5. So I'm doing these adjustments on the question paper for the moment, and we'll go back and have a look at. So this is increasing by 3.5 credit losses. Okay, we've done that one. Then the next thing is the allowance for credit losses must be adjusted to 2,000. So don't get muddled up between the expense account credit losses and the negative asset account allowance for credit losses. Okay, so the carrying balance of our allowance for credit losses must be 2,000. So let's see, what is it currently? My allowance for credit losses is currently 2,500, and I want that to equal 2,000. So that means I must make a 500 Rand adjustment. Allowance for credit losses is a credit. It must be 2,000 credit. So that means I've got to debit my allowance for credit losses account with 500 Rand in order to get it down to 2,000. So if I'm debiting allowance for credit losses, I must debit, sorry, I am debiting my allowance for credit losses with 500. I must credit my allowance credit losses adjustment account. by 500. Okay. Debit that, credit the adjustment account. Whether this adjustment account gets a credit or a debit will all depend on whether you are increasing your credit, your allowance for credit losses, or whether you are decreasing it. In this case, we're decreasing it. So that's why we will credit the adjustment account. So that in effect becomes a type of income, because the adjustment account belongs in our statement of profit or loss section, which means that if it is a credit, it is an income. Okay, so we've done that. And then the next one is we must provide depreciation on vehicles of 55,000 for the current financial year. So if we go back here and we have a look, we'll see that we haven't yet got our depreciation account. So I want to depreciation, what did they say, 55,000? That's going to be added to our list of accounts here. So I've made a note of that. And then the next one says the owner withdrew 250,000 Rand cash over the course of the year for his personal use, and this entry still needs to be recorded. So remember, when the owner transacts with the company, we have to use one of our two proprietary accounts, either capital or drawings. So we use the capital account when the owner makes additional contributions, and we use the drawings account when the owner takes either goods or cash out of the business. So in this case, he's taken cash, so we must charge that 250 Rand to the drawings account. Have they got the drawings account yet? No, drawings account isn't there yet. But the drawings account belongs on the balance sheet side, so I'm not going to write it at the bottom. Drawings was 215,000. So when we record that journal entry, we are going to debit. Where's my dead click? We are going to debit the drawings account with 215,000 in order to increase it, and we will credit bank account with 215,000. Okay, debit drawings and bank here would get the credit. We haven't yet recorded the fact that the owner took that money. So we're happy that we've recorded the drawings for the year. And the next one is an amount of 1,000 for telephone. Okay, it was incorrectly debited to, so salaries and wages were too much and telephone was too little. So salaries and wages over here was too much by 1,000. So we're going to reduce that by 1,000. And telephone was too little. Remember, there must be a debit and a credit. Okay, so I've taken note of that. And then the last one was my interest earned for the year. So we've already got that recorded in our general journal, but again, just for purposes of making a note over here of all of our adjustments that are going to affect or be in addition to these accounts. We don't have interest income, so that's going to be an additional account in addition to these ones here. Okay, so in addition to these accounts that we've got, we have adjusted cost of sales, we've adjusted salaries and wages, we've adjusted stationery expense, we've adjusted carriage on sales, credit losses we've increased, telephone we've adjusted, and in addition to that, we've now got credit losses adjustment account, the depreciation account, and the interest income account as well. So these are the accounts that will now appear in our statement of profit or loss. So we can now go and compile that, draw it up neatly. Okay. It must be headed correctly, like a proper statement of profit or loss and other comprehensive income for the year ended with the name of the company and the year ending date. We use this column at the beginning here to list the name of the account, and then we've got a column for the debits and a column for the credits, so that at the end of the day we can work out, have they done that? Sorry, no, what have we done here? In statement of profit or loss, we've got two columns, because this column on the left hand side, I'm going to call it a workings column. It's kind of like a workings or a subtotal column, and then we use that, and then we carry the total amounts over to the second column. Okay, so let's have a look. What have we got here? And let's go back to our question paper just quickly. Here we have got, here's our sales account, but we have got sales returns. So we know that our sales line in our income statement must be sales minus sales returns. So we've got, and it must be called revenue. Remember, we must use the correct terminology in the statement of profit or loss. So the correct term is revenue, and that is the sales minus sales returns. That gives us our total there. Then the next line in our SPL is less cost of sales. And our cost of sales figure we've adjusted. It was 914, and we've increased that by 2,000 for that inventory that we had to adjust for. Revenue minus cost of sales equals gross profit. So that line must appear there. And then underneath gross profit, we then put all other income. So other income is a subheading. And underneath that, we list all the different types of other income that we have besides our trading revenue. So we've got our allowance for credit losses was a credit, which is makes it an income account, and our interest on fixed deposit was an income. Remember here, we credited the allowance for credit losses, so that made it an income, and we've also got interest income. That will then give us gross income. So our two incomes added together is a total of other income for 9,500. So 9,000 plus 500 is 9,500. Gross profit plus other income gives us gross income of 491. Then when we're happy that we've dealt with all of the income accounts, underneath that we then deduct all of our other, what we call, you can also, which is probably just easier, right here, operating expenses. So less operating expenses or less distribution, admin, and other expenses. Here we are going to total these amounts here in our workings column. So all of our expenses are going to come from, we've done sales, cost of sales, and sales returns. We've dealt with those. So salaries and wages is next. And remember, that's now going to be 640 minus 1,000 to make that correction. Then stationery is next, and we've got 84.5 minus the 4.5 that we've still got in inventory in consumables. So that makes that 80. The next one is carriage on sales. And again, we made an adjustment. We reduced carriage on sales by 2.5 for that prepayment. So there's our 21.2. See how they've recorded the calculation of our opening amount on the pre-adjustment trial balance, plus or minus the adjustment, and then recorded the correct closing amount in the actual statement itself. Credit losses, we already had 13,500 and we wrote off another 3,500 bad debts. So that gives us a total of 17,000 there. Our telephone, we already had 82.5, but then we had that 1,000 Rand correction that we had to record. And then depreciation is a new account that we didn't have there before. In other words, depreciation wasn't listed here. So we're going to add that and record our 55,000 Rand depreciation. And then if we go back here, sales, cost of sales, return, salary, stationary carriage, credit losses, telephone, credit losses adjustment, depreciation and interest income. Yes, we've got all of those in our income statement. So then we can add up all the expenses, giving us the subtotal here, which we carry over to the total column. And we then got gross income minus, you must use brackets to indicate that it's minus, all of our operating expenses. And that gives us, because that final amount is in brackets, it means that it is a loss, net loss for the year. If that amount had have been a positive, then that would have been a profit. Because remember, our revenue recorded as a positive figure at the top, and all of our other income we also recorded as a positive figure at the top. So if we had profits, it would still be positive, and all of our expenses are negative. So if our total is negative, that means we've made a loss for the year. Okay. So that is how you then go about doing the workings for and constructing your statement of profit or loss and other comprehensive income when they give you a pre-adjustment trial balance and a list of all sorts of additional information. And we can tick that last one off because we did remember to record our interest. Okay. That's how I would do it. You've got all of your initial workings here. You can, when you do it here, you can also double check that you are debiting and crediting something with each adjustment amount so that you know you haven't left anything out, and you write on your extra accounts here so that when you construct it, you can see all of your workings here. But don't forget, even if you've done workings on your question paper here while you were doing this and organizing yourself, when you come to write your answer down, you must show all of the workings here in your answer. Okay. And then the last part of this question was they asked for the statement of changes in equity for the year. So this is an easy one. Statement of changes in equity means, remember, your format of statement in changes in equity will always be the same. You'll start out with the opening capital for the current year. You will add to that any new contributions made by the owner during the year, the value of any new contributions made. You will add your profit for the year or subtract your loss for the year from your statement of profit and loss. And then you will subtract the total drawings for the year. And that will give you your closing capital balance. So from our pre-adjustment trial balance, we saw earlier on that this was our balances at the 1st of May was what they had put on the pre-adjustment trial balance. So that you write that down, balance as at, and you put the date of the beginning of the year. You must have this additional contributions or plus contributions for the year. That line must appear there even though there were, in this case, no contributions. It forms part of the official format of the statement of changes in equity, and that line must be there. Then underneath that, we then add profit or deduct loss for the year. And this amount here, So we've got less loss for the year. This amount must come from your total on question 4.2 in order to get that method mark. And then finally, the last entry that we write or line item on our statement of changes in equity is less drawings for the year. And they gave us that 215. Opening balance plus contributions minus loss minus drawings equals closing balance as at the end of the year, 30th of April 2020. And again, it must be headed correctly because it is one of your official statements of financial, one of your official financial parts of your official set of financial statements. Okay. Everybody happy where those amounts came from? And that is the end of this question. Just to quickly show you those minutes, you had 22 minutes for the statement of profit or loss, and I definitely think you can do that in 22 minutes. This 13 minutes is quite tight for the journal entries. You must slow down, take your time, don't get those incorrect, and you can definitely make up some time here in these 22 minutes because you've already done most of your workings here when you did 4.1. And the other adjustments that you have to make with these other, with the other information are not that time consuming. And they've given you 5 minutes only for the statement of changes in equity, which again shows you've got to know that format of your statement off by heart so that you can quickly write down the heading, opening balance, plus contributions, plus profit, minus drawings. Did I leave anything out? Equals closing balance, so that you can complete that in 5 minutes. Okay, guys, so that is then a really nice question from your Learning Unit 4, Financial Statements of the Sole Trader. And I'm glad that's practiced some journal entries. It's another statement of profit or loss. I know we've already done one, but it is another one in your statement of changes in equity. So that was what was practiced in this question. So again, guys, very good luck for the exams. I hope all of these extra questions are helping you to form in your minds exactly what you've got to do. And I'm going to end off the recording here, and then I will see you guys again soon. Thanks, guys. Bye.